a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Now we're going to find out more about Fang ETFs with our ETF Research Director, Nina Mishra. And this is not just any ordinary Fang ETFs. These are leveraged.
Triple leveraged.
Triple leveraged,
yeah.
right? And maybe inverse also?
One inverse.
Okay. What's up with that?
Okay. So, you know, these Fang stocks, Facebook, Apple, Netflix, and Google have been very popular with their investors. They were very hot because of their sky-high returns and also very strong growth potential. But, you know, there are some skeptics also who believe that these stocks, their best days are already behind them and their valuations look too stretched. So if you love or hate Fang stocks too much, then you can take a look at these newly launched triple leveraged Fang ETNs. They are actually structured as ETNs. Both these launched on the 22nd of January. They are based on the NYSE Fang Plus index. Now, Fang, as I mentioned, usually refers to just those 4 stocks, but you cannot have an ETF or ETN based on just 4 stocks. So actually the index includes some more, again, very hot tech and internet stocks. You can go to the website of the index, NYSE Fang Index, and you will see the underlying stocks are Facebook, Apple, Amazon, Netflix, Google, Alibaba, and Baidu. Both are Chinese giants. NVIDIA, very popular, very hot chip stock, and and Tesla and Twitter. The index holds all these 10 stocks in equal weights.
All also popular, even the non-Fang stocks.
Yes, they're all very popular and they all have been very hot. Now, on the website, you will also see the performance of the index, which kind of explains why they have been so hot and very popular with investors. It has back-tested performance data since 2014, September 19, 2014, and you can see that during this period, the NYSE Fang Plus index, the index these ETNs are based on, returned 29.1%, which was far ahead of 15.9% for the Nasdaq 100 index and 10.5% for the S&P 500 index. And now, the first one is called FNGU, the ticker FNGU. This is triple leveraged NYSE Fang Index ETN. So it aims to deliver 3 times the daily price movement of this index. The other one, FNGD, the ticker, it aims to deliver 3 times inverse the daily price movement of the index. Both these are structured as exchange traded notes, which we will discuss a little bit more when we go to the next slide. And both have an expense ratio of 95 basis points. So what does this triple leverage mean? It means that if index on some day returns 10%, say, then FNGU will be up 30% on that day, and FNGD will be down 30% on that day. But they are tracked to track only daily performance. They should not be held for longer than a day if you want performance to be matching their objectives.
It also could mean very risky.
It definitely means very risky. So because they are risky products, they are suitable for short-term trading or hedging purpose only. And the ETN structure means they do not hold anything. ETNs are just senior unsecured debt obligations of the issuer, which is BMO in this case. And in fact, during the financial crisis, some of the issuers went bankrupt, and there were a couple cases where investors actually lost their money. So if anything happens to BMO, then investors may or may not get their full money back.
So they can be called.
They can be called also. So because a call feature is there in the exchange traded notes. So usually these have a maturity date, but they can be called by the issuer anytime before maturity also, like we saw in case of a couple volatility ETNs last week. And leverage and inverse ETFs and ETNs, investors should always remember that they are designed to match their stated objective just on a daily basis. If you hold them for a period longer than 1 day, then their performance can differ significantly from what you expect.
So you really have to be watching these.
You have to be monitoring them on a daily basis.
Yep.
In fact, on the sponsor's website, it is clearly stated that you may lose some or all of your principal.
Well, there you go.
If you hold it for a long time. And on the next slide, in fact, I have this performance since inception, and this really explains how they are designed to match their objectives just on a daily basis. The period has not been long, just about 15-20 trading days since they launched. So during this period, the ETN with the ticker FNGU is up about 4.3%, and the FNGD is down about 10.3%. Now, during this period, index gained 3.6%.
Okay.
So if you expected that FNGU would be up more than 10%, triple the index's performance of 3.6%, no, it doesn't work that way. FNGU was up just about 4%, whereas the other one, which was triple inverse, was down more than 10%.
So there's a lot to get your head around here.
Yes, sure.
Before you plunge into these things.
Yes, if you want to trade them, hold them for a day or two. If you see strong momentum in the market on either side, if the market is soaring or the market is plunging, then probably you can play them for a day or two if you understand them. And another thing is that this daily compounding, which impacts returns, which we see clearly on this chart, this can work in either direction. It can positively or negatively impact returns. When the market is very smooth, trending upwards or downwards, then this compounding usually has a positive impact. But when the markets are very volatile, then compounding leads to negative impact, which happened in this case.
Okay, I have to ask, do you own either of them?
I do not.
Okay. Thanks for the information. Don't forget more ETF information in the ETF section of Zacks.com. Use the Funds tab in the top toolbar, and it will help guide you to that section, where you can also see more commentary written by Nina herself. With Nina, I'm Terry Ruffalo.